This week, the traditional mortgage market is in upheaval. Are reverse mortgages the recession-proof solution? Welcome back to the Industry Leader Update. The pieces are now falling into place. Consumer spending has dropped considerably and the stock market has suffered large losses. And big ticket items and even housing could be deflating in value. But today, inflation is crushing consumers who are now cutting back on their discretionary spending. Just last week, the nation's two largest retailers, Walmart and Target, reported massive drops in their profits. Target alone, they shed 25% of their stock value last week after they reported a stunning 52% drop in profits. CNN Business reports Target was also forced to write down the value of their excess inventory that's just sitting in warehouses. In other words, the consumer is on strike and they're only buying necessities. Traditional mortgage lending is feeling the full brunt of the economic forces that have returned to roost after being dormant for decades long. That is inflation and rising interest rates. On the supply side, the National Association of Home Builders released a report, and it shows that home buyer traffic for new homes or new home construction is down 29% year over year from May 2021. In a statement, the association said, "In a sign that the housing market is now slowing, builder confidence took a steep drop in May as growing affordability challenges in the form of rapidly rising interest rates, double-digit price increases for material costs, and ongoing home price appreciation are taking a toll on buyer demand." The finance side of the housing market is also feeling the brunt of the economic storm. The average 30-year fixed-rate mortgage began at 3.66 in February, but today is now floating around 5.45%. And consequently, purchase and refi applications have tumbled. Mortgage News Daily reports that both suffered double-digit hits with its market composite index. Now that measures application volume, and it's dropped 11% from just the previous week. And year to year, application volume is down 15%. Refinance volumes have also fallen off a cliff naturally. Today, home refis are down 76% from May of last year. Now, the issue is not just merely interest rates. Now, case in point, in November 2018, the average 30-year fixed rate loan was nearly 5%, or just 1/2 point less than it is today. But the rub we're seeing now is both the massive inflation of home values and the inflation of consumer goods. The median home price in November 2018 was $322,000. Today it's $428,000. The Consumer Price Index, which is a measure of inflation of consumer goods, was only 2.2% in November 2018. Today, the annually adjusted inflation rate is estimated to be 8.5%. So it's natural that higher mortgage payments, coupled with rapidly increasing price of consumer goods, is now pushing many out of the housing market. They simply can't afford both. And it's causing others to discard any hope of doing a refinance or a home equity line of credit. As a result, many mortgage lenders are now eyeing reverse mortgages, and who could blame them? Unlike younger homeowners today who have little or no equity, the older homeowner is now sitting on trillions of dollars of accumulated equity, and many who would qualify for a reverse mortgage, they could, even at today's interest rates. Unbelievable, right? Well, anecdotal reports already are indicating today's changing market is pushing many who sat on the fence and who previously considered a reverse mortgage into application status. Traditional mortgage lenders without a reverse mortgage division are going to find that moving into reverse mortgage lending is not only a logistical challenge, but it's also culturally foreign to most of their sales force because of the length of the sales cycle. However, those lenders who have already bifurcated their business into a traditional and reverse business line can more easily pivot and prioritize their investment and their energies toward reverse mortgage lending. Wholesale mortgage brokers, they're going to be shopping for turnkey reverse mortgage business models, and those who have them stand to gain. One thing is certain, the historical increase of reverse mortgage loan activity corresponds with the number of active lenders originating the loan. Now, does that mean we're going to see the return of one or two large retail bank brands? It's unlikely, and it's also too early to tell. However, With necessity being the mother of innovation, we can expect to see more small to mid-sized banks and mortgage lenders move to reverse. And in the end, that is a good thing. What are your thoughts? Leave your comments in the comment section below. And also, if you'd be so kind as to share today's video post on your LinkedIn, Facebook, and Twitter accounts. Our YouTube channel, Heckam World, is available for you to subscribe and also to click the notification bell. That way you never miss a new episode that's come out. And each and every week, as I always remind you, you can catch your reverse mortgage news on the go with the nation's only, actually, weekly reverse mortgage podcast. We have news, commentary, and analysis, Heckam World Weekly. If you're an Apple user, you can listen and subscribe on iTunes. That's a wrap for us this week. Thanks again for joining us, and happy originating.